Wherever you are in Canada, welcome back to the channel that keeps your money matters clear, current, and completely Canadian. Today, we're diving into an important financial development that every working Canadian, every employer, and every self-employed individual needs to know about. Yes, we're talking about the Canada Pension Plan, and more specifically, the recently announced CPP increase for 2025. This change is more than just a headline. It's going to impact your paycheck directly. That means more money will be deducted from your income. Whether you're salaried, hourly, or running your own small business, these changes will affect you in one way or another. But what does the increase actually look like in dollars and cents? Why is it happening? And what does it mean for your future pension? We're unpacking the full story. From what the CPP expansion really means to who's paying more and how much, we're covering it all. And trust me, you'll want to stick around to the end, especially if you're self-employed or earning over $70,000 a year. Let's get into it. The announcement that's shaking up paychecks: the federal government has officially confirmed that CPP premiums are going up in 2025. This isn't a sudden decision. It's part of a phased expansion that actually began several years ago. But 2025 marks a critical stage in that expansion. Why? Because not only are contribution rates going up slightly again this year, but we're also seeing a second earnings ceiling added, meaning that people who earn more will be contributing more, even after reaching the regular CPP maximum. So if you thought you were done with CPP deductions once you hit that annual earnings limit, think again. The Canada Revenue Agency and the federal government are introducing what's called a second additional CPP contribution, or CPP2. This is a relatively new concept, and it's going to catch a lot of people off guard. The aim is to expand retirement benefits for future Canadians, but the price is being paid today by workers and businesses. Before we explain what's changing, it helps to understand how the system works right now. The Canada Pension Plan is a mandatory program that provides retirement income to Canadians. If you're working and earning more than $3,500 a year, you are required to contribute to the CPP. Your employer also contributes an equal amount on your behalf. If you're self-employed, you're responsible for both the employee and employer portions yourself. As of 2024, employees contributed 5.95% of their income to CPP, and employers matched that. These contributions were only applied to earnings between $3,500 and the year's maximum pensionable earnings, or YMPE, which was $68,500 last year. This limit is adjusted every year based on average wage growth in Canada. But in 2025, the YMPE is jumping significantly to $73,200. That means a larger portion of your income is now subject to CPP deductions. That alone would result in higher deductions. But there's more. In 2024, the government also introduced the first stage of the CPP2 tier. In 2025, it expands further. Now, if you earn between $73,200 and $87,000, you will be subject to a second round of deductions, 4% on that additional chunk of income. So not only is the ceiling rising, but a second ceiling is being introduced. This is a massive change in how Canadians pay into CPP. For the first time in history, two different contribution levels are being applied to two different income brackets. Say you're earning $75,000 a year. Under the 2024 rules, your CPP contributions would have been capped when you hit $68,500 in income. That means your maximum annual contribution would have been around $3,867.50. Now, with the YMPE moving to $73,200, more of your income is subject to the 5.95% base contribution rate. That alone increases your annual deduction to nearly $4,100. But now let's factor in the second tier. That $1,800 of income between $73,200 and $75,000 gets hit with an extra 4% deduction. That's an additional $72, bringing your total CPP deduction to around $4,172. Now imagine you're earning $87,000 or more. In 2025, you'll be paying the full maximum for both tiers. That means So your total annual CPP deduction will exceed $4,650. Compare that to last year's maximum of around $3,867. That's an increase of nearly $800 in just 1 year. If you're self-employed, you're paying both halves, which means your contribution will be nearly $9,300 in 2025. That's almost as much as some people pay in income tax. Let's be honest, anytime we see more money being deducted from our paychecks, it raises eyebrows. But the government says these changes are necessary to make the CPP more sustainable and more generous for future generations. The story goes back to 2016, when the federal and provincial governments agreed to gradually enhance the CPP. The aim was to increase retirement benefits for younger workers who might not have access to workplace pensions. At the time, CPP only replaced up to 25% of your average income in retirement. But with this expansion, the goal is to raise that replacement rate to 33%. That might not sound like much, but it could translate to thousands of dollars more every year in retirement. However, to fund those higher benefits, we need to make higher contributions now. So today's workers, you and me, are paying more so that when we retire in the future, we'll be eligible for larger payouts. It's a classic pay now, benefit later system. But that doesn't help much if you're already retired or nearing retirement age. One of the biggest questions we've heard is whether current seniors will see any benefit from this increase. The simple answer: not directly. The expanded CPP benefits are only available to those who contribute under the new rules. So if you're already retired and collecting CPP, you won't see a sudden boost to your monthly payment because of these new tiers. However, you will still benefit from the annual inflation indexation. CPP payments are adjusted every January to reflect the Consumer Price Index. In 2025, for example, payments went up by 4.4% due to rising inflation. But that increase is separate from the contribution expansion we're talking about. So no, the 2025 CPP increase doesn't mean extra money for retirees now. But if you're still working, even if you're close to retirement, and contributing more under these new tiers, you may qualify for slightly higher payments later on. The impact on working Canadians, let's not sugarcoat it. This increase is going to be felt in every paycheck. Whether you're making $50,000 or $100,000, more of your income is being deducted. In a time when Canadians are already feeling the pinch from high grocery prices, rising rent, climbing mortgage payments, and elevated interest rates, every extra dollar deducted from your income stings a little more. For those on tight monthly budgets, this could mean cutting back even further, maybe canceling subscriptions, delaying vacation plans, or reducing retirement contributions to private accounts like RRSPs. Some families might even find themselves having to dip into savings just to make up for the shortfall. And it's not just workers. Employers are also affected, as they must match the increased contributions. For small businesses, this creates another financial strain, potentially influencing decisions on hiring, wages, or employee benefits. Self-employed Canadians. The silent sufferers. Now let's shine a light on the group that arguably gets hit the hardest by this change. Self-employed Canadians. This includes freelancers, independent contractors, small business owners, and gig workers. For this group, the CPP expansion represents a double whammy. Why? Because self-employed individuals have to pay both the employee and employer portions of the CPP contribution, and that now includes both Tier 1 and Tier 2. So if you're self-employed and earning $87,000 or more in 2025, you'll be paying close to $9,300 a year in CPP premiums. That's money straight out of your pocket with no employer to share the burden. Understandably, many self-employed individuals are now considering different strategies, like paying themselves in dividends instead of salary to reduce CPP exposure. But those strategies come with trade-offs and risks, especially when it comes to building up enough pensionable income to qualify for full CPP benefits in retirement. So what can you do to prepare for these changes and lessen the financial strain? Here are a few practical tips that might help. First, check your pay stub in early 2025 and compare it to what you saw in 2024. Make sure the CPP deductions align with your income and the new contribution tiers. If something looks off, raise it with your payroll department or accountant. Second, plan your savings accordingly. If the CPP deductions are reducing your ability to contribute to an RRSP or TFSA, consider adjusting your budget to make room. These personal savings vehicles still play a vital role in your long-term financial security. Third, if you're self-employed, this is the time to consult a financial advisor. You may want to reevaluate how you pay yourself, how much you're setting aside for taxes and retirement, and whether your current business structure still makes sense under the new CPP regime. At the end of the day, many Canadians are wondering, is CPP still worth paying into? After all, more is being taken out of our paychecks now than ever before. Is the system giving us a fair return? The answer is, it depends on your perspective. For most Canadians, especially those without access to private pensions, CPP remains one of the most stable and secure sources of retirement income. It's backed by government guarantees, indexed to inflation, and paid for life. But it's also true that CPP contributions are becoming more expensive. And for high-income earners and the self-employed, it may feel like the costs are outweighing the benefits. What's clear is that retirement planning is no longer something we can afford to ignore. With the CPP expanding, we're entering a new era of retirement savings in Canada, and being informed is the first step in being prepared. Thanks for watching today's deep dive into the 2025 CPP changes. If this video helped clarify what's coming and how it affects you, please give it a thumbs up. And don't forget to subscribe for more updates on Canadian pensions, benefits, and financial news. Drop a comment below. Are you okay with the CPP increase? Or does it feel like just another tax? We want to hear your thoughts. Until next time, stay informed, stay empowered, and stay financially savvy, Canada.